Dividend's growth stocks to buy now. Over the years, the stock market has always experienced crashes and periods of recession that always have an economic impact on investors and corporations. The stock market experienced its biggest one-day decline on October 19, 1987, which became known as Black Monday by many. The U.S. Stock Exchange also experienced a bear market between 2007 and 2009 when the S&P 500 lost almost 51.9% of its value. A recent market crash was the coronavirus stock market crash of 2020, which lasted for several months. As soon as the stock market started recovering from this recent crash, the world was plunged into another period of recession, which it is yet to recover from. This was triggered by the oil price drop and the Russian-Ukraine war. Investors have borne the brunt of these steep losses amid all the uncertainties, as many have acted in panic and lost a lot of money. However, periods of recession can open new opportunities for smart investors to earn profits. Our goal on this channel is to help you become financially independent so you can live life on your own terms, so we're sharing our top 5 dividend growth stocks that we think you should consider. If you haven't subscribed to our channel, make sure you click on the like and subscribe button and stay till the end of this video because the last stock we're sharing is our favorite and we think you'll like it best. Now, without further ado, here's our first pick. FedEx Corporation. FedEx is an American transportation and courier service provider founded in 1973. As one of the first courier service providers in the U.S. and the world, FedEx focuses on transportation, e-commerce, and business services. Today, the company is known for its air delivery service. When it absolutely, positively has to be there overnight, it's not just a package, it's your business, and the world on time are popular FedEx slogans, and I'm sure you must have heard one of them. In 2022, FedEx generated a total revenue of about $93.5 billion. FedEx, a company that relies on how good the global economy is to generate its own profit, was hurt by the coronavirus pandemic as the world's economy was left in shambles due to a reduction in demand. The company's profit was hurt and its stock price fell during the pandemic from around $170 to around $105 in March 2020. The company's stock soon spiked due to increased demand as countries, companies, and individuals started using FedEx services to restock and refill their supply chains as coronavirus restrictions were lifted. In February 2021, FedEx stock reached an all-time high of about $315. The stock is currently priced at around $175. The dividend yield of FedEx currently stands at around 2.1%, close to the maximum yield of 2.7% it achieved in March 2020, and better than its 4-year average yield of 1.44%. The stock also has a normal dividend payout ratio of about 28%. It is also important to note that FedEx has had just 1 year of uninterrupted dividend growth. With this valuation, and coupled with the fact that the company has paid dividends consistently for 19 years, the company should have no problem with the continual payment of dividends. While EPS for FedEx is expected to grow by 6% over the next 5 years, it has grown at a rate of 8.2% over the past 9 years. We also estimate that the stock's annual dividend growth rate over the next 5 years will also be 6% after having an annual growth rate of over 26% in the last 9 years. In 2013 and 2014, FedEx had a 15% and 12% return on invested capital, respectively. However, these values have fluctuated over the years, giving an average of about 9%. Although the coronavirus pandemic was a blessing in disguise for the company, as its e-commerce business growth was accelerated by more than 50%, it couldn't replicate this success in terms of its return on total capital investment. Our model suggests that FedEx stock will have an estimated 5-year annual return of 11.6% when including the dividend yield and share price appreciation. The company is also expected to generate more profits and save more with the cost-cutting strategy it wants to adopt in 2023. Overall, we think that FedEx stock is a dividend stock that will grow over the years, and it may be worth keeping an eye on. Franklin Resources. Franklin Resources, Inc. is an American financial services corporation offering multi-asset solutions, investment, fixed income, and equity management to private, professional, and institutional investors globally. As of 2020, the company holds over $1.4 trillion in assets from various clients and investors. The company also holds mutual funds and helps in retirement planning. In 2021, Franklin Resources and its subsidiaries had a total revenue of about $8.43 billion. The COVID-19 pandemic affected Franklin Resources as it did other companies in different sectors. Before the widespread effect of the recession caused by the pandemic, BEN traded at around $30. However, this value soon experienced a drastic decline as it was cut by almost 50% as the stock price of BEN hit a low of about $15 during the height of the pandemic. After the struggles of 2020, the stock's price rallied to around $35 in July 2021. Currently, BEN is priced at around $26. BEN has a decent dividend yield of about 4.41%, a little less than its 4 years average dividend yield of 4.81%. The company's dividend ratio, i.e. the amount of percentage the company pays out in relation to its total earnings, is around 46%. BEN has an excellent track record of paying dividends to shareholders with an impressive 25 years of consecutive dividend growth, making this stock a dividend aristocrat. This analysis shows that the company has no problem with dividend payments. The stock's EPS growth rate over the last decade is not impressive as it is in the red. Over the past 9 years, BEN has had an annual EPS growth rate of about negative 3.1%, while the stock's dividend growth rate over the same time is the exact opposite of the EPS growth rate, around 13% annually. According to our model, BEN's EPS growth rate is projected to be about 5% over the next 5 years, with the DPS growth rate just a percentage less at 4%. BEN has an average ROIC of 11.3% over the past 9 years. The inconsistencies experienced during and after the pandemic is a major factor in this reduced figure. In 2021, the company has an approximated return on total capital of 10%. Our conservative analysis and research point out that BEN is a dividend growth stock that can be a nice alternative to retail stocks. Currently valued at less than $30, BEN stock has an estimated 5-year annual return of around 6.4%. With a past record of about 13% dividend growth and an expected 5% annual dividend growth going forward, we think BEN could be a great dividend growth stock to consider at a lower price. Amgen Incorporations. Third on our list of top dividend growth stocks in our video is Amgen Inc. Amgen is an American multinational biopharmaceutical company whose goal is to provide healthcare based on recombinant DNA technology. The company focuses on illnesses with limited treatment options by discovering and developing innovative solutions and human therapeutics. Some of Amgen's products include Aimovig, Kineret, Cenespar, Neulasta, Enbrel, etc. The company has more than 24,000 employees and more than $25 billion in total revenue. Amgen wasn't left out of the coronavirus recession as the pandemic limited patient interactions with healthcare providers while reducing sales volume and the number of new patients starting treatment. Even though the stock's price declined and was around $188 in March 2020, AMGN's price soon rebounded to follow an uptrend that continued till today. This uptrend was due to the company's recovery from the COVID-19 pandemic and its strategic partnership deals with other companies, such as Arrakis Therapeutics, which earned it several billions of dollars. The company's stock hit a high of around $288 in the middle of this month, but is currently around $282. Amgen looks strong in a period when most of the stock markets are struggling. Amgen's stock price increase can be traced to the company's obesity and weight loss treatment, AMG 133, which has demonstrated positive trial results. Although the drug has yet to gain regulatory approval, it has changed the market sentiment in favor of AMGN stock. The stock also pays a dividend that yields around 2.8% compared to the sector's median of about 1.5%. AMGN currently has a dividend payout ratio of over 45%. We think AMGN should have no problem paying its shareholders dividends because they have recorded steady growth in their dividend with 11 consecutive years of growth while also paying dividends consistently over the last 11 years. Over the last decade, the company has also had an average annual EPS growth rate of 11.7% and an impressive annual DPS growth rate of 20.6%. We project that the EPS and DPS in the next 5 years are estimated to grow annually at 9% each. AMGN's return on invested capital also looks pretty good, as the company has an average ROIC of 12.3%. The company had seen a steady increase in its ROIC except in 2017, when it had an ROIC of 3%. In 2021, the company made around 14% on its investors' dollar, a strong figure when compared to the industry's average. Priced at over $280 with a dividend stock yield of around 3%, our model expects a 5-year estimated annual return of 7.9%. This positioned Amgen as a stock that will do well over time, as it is proving to be a dividend stock with good growth potential and a great yield. You might want to consider this stock as well. American Express. American Express is a top company in the banking and financial services provider industry. Having carved a reputation for itself, this bank is a household name when it comes to card payment services. As a bank and global card payment company, AXP is a leading personal, corporate, and business credit card issuer. The cards can also be used during your travels to make purchases overseas. With over 120 million cards issued, including about 56 million in the United States, there is a high chance that an American Express card is owned by you or someone close to you. The company has a total revenue of around $43 billion in 2021 and over 60,000 employees. American Express was one of the companies badly hit by the COVID-19 recession, as the virus upended the retail industry as consumer spending dropped drastically. Fewer customers used their cards as restrictions slowed travel and shopping. At the height of the pandemic, the price of AMEX plummeted to around $75. It was at the end of the pandemic before the stock recovered. In February 2022, the stock rallied to about $194. AMEX is currently priced at around $154 per unit. In the last few months, AXP has done fairly well, gaining more than its card payment industry competitors. The stock has a dividend yield of around 1.2%, which is slightly lower than the sector's median. The stock has a payout ratio of 20% and has paid dividends for 33 consecutive years. However, it has only had 1 year of consecutive dividend growth. AXP has had an EPS growth rate of 8.9% over the last 9 years, and we project that the growth will continue over the next 5 years at a growth rate of about 7% annually. The stock's DPS is also expected to have a growth rate of 8% over the next 5 years, having had an average growth rate of 11.5% in the last 9 years. American Express's return on invested capital has not been convincing over the years, but the company recorded a 12% ROIC in 2021, a testament to a growing dividend stock. Although the average stands at 7.2%, our model suggests that this value will keep increasing. Even though the dividend yield of AXP is currently below 2%, what the company lacked in yield, it made up for in safety, consistency in payment, and growth. With a current price of around $154 per share, and given its conservative earnings per share growth estimates of 7%, we think AXP can do over 6.6% annual return over the next 5 years. AXP is a dividend growth stock that you might want to consider for long-term investment, as it looks like the company's stock will keep growing. McDonald's Corporation. McDonald's is an American fast food corporation that needs no introduction. The company has grown to become one of the world's leading food service brands, with over 36,000 restaurants in more than 100 countries. McDonald's products include fast foods such as hamburgers, chicken, French fries, soft drinks, coffee, breakfast, etc. The company had a revenue of over $23 billion in 2021. Amid the economic pressure and instability that came with the coronavirus pandemic, McDonald's has managed to keep its valuation and manage its account books. After the short decline the company experienced during the pandemic, where it slumped to around $150, largely due to the general market meltdown, the company quickly rebounded and has since witnessed a surge in price. MCD is at its highest price since the COVID-19 period, which is currently around $270. MCD is backed by strong liquidity and has sustained its dominance of the consumer discretionary sector with about 39% of the total market share. With a dividend yield of just above 2%, it is still around the 4-year average of 2.3%, a little above the sector's median and the S&P 500's yield of around 1.8%. The company also has a dividend payout ratio of about 56%. Despite a decrease due to the market's current volatility, MCD has always consistently experienced dividend growth, with its 27 years of dividend growth and payments being one of the highest in the industry. This means that MCD can cover dividend payments without having to borrow. McDonald's has grown considerably well in terms of its EPS and DPS in the last decade, with an EPS growth rate of 7% and a DPS growth rate of 7.5% in that period. In the next 5 years, we project that MCD will have an EPS growth rate of 19% and a DPS growth rate of 5%. The company also boasts of a strong ROTC of over 15%. MCD has an average return on invested capital of about 19.6%, indicating the company's profitability. A major growth driver for McDonald's is how fast it adapted to changes in consumer behavior, which has leaned towards digital delivery since the COVID period. This has led to the company's expansion, which ultimately means more profit. With a 5-year estimated annual return of around 13.1%, MCD topped our list of dividend growth stocks in our video today. The company has solid fundamentals, a capacity to expand further, and the ability to continue the payment of dividends. We think McDonald's is a dividend growth stock that can improve your investment portfolio. Thank you for watching our video on top dividend growth stocks to the end. Destroy the like and subscribe buttons if you enjoyed this video, and let us know which stock pick is your favorite in the comments section below. We hope you have a fantastic day.